So market returns for the first 3 weeks of 2022 have not been full of happy reports. U.S. stocks, especially some of the biggest names and winners of 2020 and 2021, have fallen into what is called correction territory. So the question is inflation the concern? Rising interest rates? Is the Omicron variant? What's the story really? I'm Kent Kramer. I'm the Chief Investment Officer at Foster Group, and this is our financial perspectives, some thoughts we put together every couple of weeks to help investors look at the market and the economy and see what things they might be wanting to pay attention to. So today, let's look at the economy first. Initial jobless claims last week rose a bit, and continuing claims for unemployment benefits rose a bit as well. Those unemployment claims, the continuing claims, rose by 84,000 to about 1.64 million. But I think the important thing in looking at these two charts is to note that both numbers are approaching their pre-pandemic levels. In other words, things are getting back somewhat to normal when it comes to unemployment markets. Of course, employers are still struggling to find people to come to work, and there's reasons for that. One of the reasons is because this Omicron variant has really taken off. Since Christmas, the number of cases in the United States has skyrocketed, and along with that, the number of admissions to hospitals has been very high as well. One of the encouraging things to note is the hospitalization rate, the rate at which positive cases of people have to be admitted to the hospital, has really gone down almost by 2/3. It used to be 6% in January of 2021. This time around, it seems like it's running about 2% in terms of that hospitalization rate. But the number of cases is causing all kinds of disruptions. And if you've been paying attention at all, travel, school, just about any service industry that you can think of has had disruptions in their ability to have regular service. Well, here's one of the reasons why. If you look at this chart, what it's showing is that 8.8 million Americans in the first few weeks of 2022 have had either COVID positive symptoms themselves, or they've had to stay home to care for someone who's COVID positive. Think about it. 8.8 million people in the workforce have had to stay home because they themselves are sick, or they've been caring for someone who is sick. That is cause for a lot of disruption. You can see that's the biggest number that we've had since this number has started to be tracked at the beginning of the pandemic. Now, there's been a lot of things catching our eye in the headlines, but certainly the markets have been eye-catching because things seem to be going in a direction that we don't like. Markets have been in retreat. And again, a lot of the market stories have been about those companies that had very high returns in 2020 and 2021. If we look at this chart, we see names like Netflix, Peloton, Coinbase, Zoom. Those are the biggest losers here coming out of the gate in 2022. And those numbers down 34, down 24, down 23. Those are pretty big losses for the first 3 weeks of the year. If we look at drawdowns, and this is something you hear a lot in the news, they say, how far has something fallen from its high? Those numbers look even more extreme. Again, looking at Peloton, it's down over 83% from its 2020 high. That's a big decline in stock price, right? You see the same thing with Zoom video communications. As people have started to go back to work, it looks like, well, maybe that won't be the most successful company on the planet in terms of how we meet and do business. And you can see other names of companies as well. Coinbase is another one. They tend to do a lot of their trading with cryptocurrencies. Well, cryptocurrency has kind of fallen out of favor here in the last few weeks. So Coinbase as a company has fallen out of favor as well. But if we look at broader markets, those things where really more diversified investors should probably pay attention. Those broader markets, while they have been down, they haven't been down nearly as far as some of those individual names. Again, kind of highlighting the value of diversification, especially in tough market times. If you look at this chart, what you notice is emerging markets, the brown line at the top. Emerging markets was in negative territory for 2021, and it started off 2022 showing some positive returns. Again, that idea of diversification, this is through last Friday. And looking at that drawdown number, how far off the previous highs. While these numbers are no fun to look at, small companies are 18% off their high point. And then you see growth stocks and other stocks off their highs. They're not nearly down as far as some of those individual names, those high growth stocks that we saw in the previous graphs. Let's pull back even further and think about the last 3 years, because if we really just tunnel in on the last 3 weeks, I think we can get distracted by what's happening recently. If we think about our long-term investment experience, what we've seen in the last 3 years and what we hope for in the next 3 and 5 and 10 years, the last 3 years have been good for investors. Virtually any stock market that you've been invested in has been positive if you've been a diversified investor in that period. Maybe you didn't get the full growth of that 113% in the US growth market represented by the NASDAQ top 100, but any of those other equity markets in a diversified portfolio has done very well. As a matter of fact, if you look at the All Country World Index put out by Morgan Stanley, that index is up 45.8% 3 years cumulatively. If you just invested in world stocks as a whole, you would have had a really good 3-year experience. And that's in spite of the pullback last week. Kind of along that vein, let's look at a couple glass half full reminders for all of us. I think my job sometimes is to come in and say, you're hearing probably lots of negative news about what's happening in the market because people are trying to get your attention. What we want to do here is say, well, there's reasons for optimism as well. And sometimes those get lost in the noise. Many have attributed this recent market decline to the Fed's intention to raise interest rates. But a Bloomberg chart from this morning notes that during past periods of Fed tightening, when they've been raising rates, the market has largely been positive if you look at its performance across the entire rate rising period. With the exception of 72 to 74, you can see that every period of Fed tightening has been marked by positive returns, at least in measuring the S&P 500 total return during the period when the Fed was raising rates. The market is going down right now, but the Fed has not raised rates officially one time yet. It's just anticipating what might be in the future. You can kind of see where this is going. Here's another chart that we like to look at. This one shows U.S. stock market drawdowns. And what we notice here is those stock market drawdowns, they've been the norm in virtually every year. The red markers underneath the chart, they show how far the stock market fell during a given calendar year. The black line, the tall lines, those represent how far up the market was in any given year. And then the blue bar represents where it finished for the year. And what you notice here is in virtually all years, there's some kind of a drawdown in the US stock market. There's some period when it declines. We come to expect that. What happens is when those drawdowns get to be around 10% or greater, they start to get our attention. But those 10% or greater drawdowns have occurred in 24 of the 41 years since 1979. The thing we need to remember, and we don't need to look back very far, is on years when the market has a drawdown, it can still have a very positive overall return. Let's think about 2020 for a minute. The US stock market was down over 30% in the beginning of 2020 as we went into the COVID-19 pandemic. By the end of the year, that same US stock market was up over 20%. So we can see kind of this idea that drawdowns may happen, but it doesn't mean that the market year as a whole is lost simply because we've had one drawdown. We tend to be optimistic that in the long term, equity markets will be positive more often than they're negative. And we're not really making a bold prediction here. We're just looking at the historical context. And if you look at this chart, US stock market performance going back to 1926, what you note here is that the stock market has been positive 3 out of every 4 years on average. That means 1 out of every 4 is negative. But if you focus on the 3 of 4 that are positive, you can see as a long-term investor, we expect to be rewarded for continuing to invest in stocks if that makes sense with your financial plan. The also thing I'd say about stock markets is they tend to be the one asset class that has consistently outperformed inflation, provided real returns for investors over those same long periods of time. So market declines and all the reporting surrounding those declines can be pretty unsettling. It feels like we should be doing something, and this time may feel like that for you as well. And while the fear of missing out may be kind of fading a little bit right now, FOMO, there's a couple other fears that I've read about recently that might be starting to take hold for you. FOBI is the fear of being an idiot. Some people think I'm hearing all this news and I'd be an idiot not to do something. That's a fear that's being produced by a media story, not necessarily one that's related to your financial plan. The fear of losing everything, FOLE. We tend to catastrophize. So markets start to go down some and we think they're never going to stop and we're going to lose everything. History would say that's pretty unlikely to happen, especially if you're a diversified stock market investor. What's really going on here is the news media has become excellent at gaining our attention, and they know how to gain our attention through the use of fear producing headlines. They grab our eyes, they get our ear, they make us pay attention because it seems like, hey, something bad is happening. I need to pay attention to that because I must need to do something. There was a study done by a group of economists who were they felt like during the COVID period that the news media seemed to be way more negative than warranted, and they tended to underreport positive developments like the development of vaccines, let's say. So they looked at news coverage going back to the beginning of the pandemic. They looked at it not only with things related to COVID, but also related to the economy as well and markets. And what they found is the US national news media, and you can see the pink line there on the top of this chart, they feed a pretty negative daily diet of news because that's how they get our attention. But if you compare that negativity to your US local and regional news, seems to be a little less negative on that level, and international news, even less negative. I think what this is telling us, though, is really it's a market function. Those news media sources, they are for-profit companies. And in order for them to sell advertising, they need to show advertisers that they can get our attention. And they know that the way to get our attention is to use negative, fear-producing headlines and stories to do so. So while there may be a lot of negative news out there, it may not be really reflective of the actual reality on the ground, but more reflective of news organizations trying to get our attention. So if you're feeling a little pressure to take action, maybe you need to step back and say, well, what would cause me to reasonably take an action? And we would say, hey, the time to consider taking an action are if things in your life circumstances have really changed. So life circumstances like your time horizon, maybe your time to retirement has gotten shorter or longer. Maybe your employment has changed in some way. You're making more or less. One person's working in your household or two. Maybe your health has changed, family circumstances. Maybe you've seen a windfall, or maybe there's been a financial reversal. The idea here is you're looking at the circumstances that are unique to you and not necessarily driven by what's happening in the market over the last 3 weeks. Good financial plans stretch out over many years. And we think that portfolios that reflect and help people accomplish those financial plans are durable. They don't need to be changed all that often, especially not just as a result of what's happening in the market in the first 3 weeks of 2022. So if you're thinking about maybe do I need to make a plan, we'd say the first place to start is to ask yourself, let's look at our financial plan and see if something's changed that would warrant a change in the portfolio. Kind of a last quote here. President Eisenhower said this, plans are worthless, but planning is everything. What he meant by that is, as soon as we finish a plan, we know it's not going to work exactly according to plan because we can't predict the future perfectly. The future will not go exactly as we anticipate. But if we've done a good job planning, we've probably planned for a variety of potential circumstances so that when things like that happen in the future, we're not caught completely by surprise, or we haven't put all of our eggs into one basket. And if one thing goes wrong, the whole thing falls apart. Planning is a really important exercise. We think investors and individuals should revisit their financial plans at least once a year just to see, hey, what circumstances have changed in my life? And is there anything that I should be doing as a result of that? So, hey, thanks for attending. And if you'd like to take a look at your financial plan or revisit your portfolio strategy, we would love to have that conversation with you here at Foster Group. Our advisors are available every day for appointments. You can come in person, or if you'd like to meet online, we have great ways to do that as well. And we'd love to have that conversation with you. Also, if there are topics that you'd like us to address this year, you can send us that information at the contact information you see on your screen. And we'll kind of be looking at your questions and seeing which ones we can address in future editions of Financial Perspectives. Thanks for joining us today. We hope to see you in a couple of weeks.